So after we know which type of investors are out there, we have to understand how investors, all of them, make the decisions and how you as a startup can de-risk your venture to increase your chances of securing funding. And investors, no matter if they're angels or syndicates or micro VCs, all have one goal in mind, is minimizing risk, And they typically evaluate startups across 8 key areas. Here they are somewhat in order, and I walk you through step by step. So when they evaluate each startup, they start by looking at team risk, followed by market risk, product and technology risk, financial risk, regulatory risk, exit risk, scaling risk, and timing risk. Now let's dive deeper into each one. So for the team risk, it's one of the most crucial startup factors for the startup, especially if this is your first time in the founder's seat. Investors want to know if your founding team has the experience and chemistry needed and to execute the business plan, and have you worked together before, or do you have a strong bond? And if the team is strong, it significantly reduces the risk in the eyes of an investor, because often products change, and it teams that stay together. And showing a fair distribution of equity among co-founders also demonstrates that everyone is equally incentivized to stay on board long term. Then we have the market risk, which revolves around whether your target market is large enough and growing. They're looking at, let's say, X hundred returns or more. So if you need to demonstrate that there is enough opportunity in your market, should be billion, obtainable market, total addressable market, right? So, and for example, if you're in gaming or education sectors, showing data that proves these markets are growing year over year can help to de-risk the investment, right? And then we have product and technology risk. So they need to know that your product is truly innovative and that you have a competitive edge. Is your product solving a real problem? Have you already developed a prototype or MVP? For more technical products, having intellectual property like patents or a solid product roadmap can significantly reduce the technology risks. Investors want to see that you've built something that they can easily be copied, and then we have financial risk. So when it comes to it, it's all about how well you manage your money, and investors will look at your burn rate, how much you're spending each month, and whether you have a clear path to profitability. Well, in today's markets, they're especially cautious, so showing that you're keeping your burn rate low while still achieving key milestones is kind of essential. The more you can demonstrate the financial discipline, the less risky you appear. And the other risk we have is regulatory risk. So it's all about, actually financial risks here. But yeah, it's all about how you manage your money, again. And then the regulatory risk is for industries, for example, like health tech or food tech, it's a huge factor. So if your startup requires regulatory approvals, investors want to know that you have a solid plan to navigate that process. And do you have the advisors with experience in this space? Have you budgeted for legal fees? Addressing these concerns can greatly reduce regulatory risk in the eyes of investor. And then, of course, we have the exit risk. So exit risk is all about whether there is a clear path for investors to make a significant return on their investment, and they need to see that you're aiming for a large exit, like whether it's through IPO or acquisition or some other liquidity event. So show them that you're thinking big, like 100x or more in return. The more ambitious you vision, the more likely they're to invest. And finally, there is scaling risk. So scaling risk is all about how easily your startup can grow. Investors want to know that if your business model can scale quickly, can you move from 1,000 customers to 10,000 customers or 100,000 customers, and how you will handle the increased demand, and showing a solid go-to-market strategy, key partnerships, and infrastructure that supports growth will reduce the scaling risk. And then, of course, there is a timing risk. Why now? It's always the question that you would like to answer. Investors want to know why you're launching this business at this moment. Is there something unique about the market conditions or regulatory landscape that makes now the right time? And showing that your timing is spot on, perhaps due to the shift in market trends or recent regulatory change, can help de-risk the timing of your venture. Right, so here are the 8 biggest risks investors typically evaluate. I can encourage you to look at your own startup from these lenses and identify main 3 and which of these main, let's say, ones apply to you. And then think how can you de-risk each of the area. And then the more you can mitigate risk in your communications and your pitch decks, your follow-ups, the more attractive you'll become as an investment opportunity. And how exactly you can approach the investors with which message, stay tuned. I'll show you in the next video.